Okay. Happy Monday, everybody. It is April the 7th, and we're going to get started because we sort of need to finish right on the hour. So thank you for tuning in. I am your host, Hung Lu. I am with Cash Property, and today we are going to be talking about mastering vacancies in minutes in today's Money Matter episode. And the reason why this came up is because I am raising funds on a project. And one of the questions that came up recently was, Hong, there's X amount of units in this opportunity that you have. How realistic is that vacancy number that you're running your numbers on? So that's why I'm going to show you the calculation, and we're going to run through that because whether it's on one of my projects or somebody else's projects, or your own project, you really should know and understand the vacancy. And if you can grasp the importance of this number, it will go a long way in helping you make the right decisions around the type of opportunities you want to invest in. Okay, so we are April the 7th. Time is flying in 2025. So we are going to get right into it. Oh, before I forget, all right. So let me share this because we do have a couple of sponsorships to recognize. So let's jump right in. We will start with this one. So if you are in Vancouver, Toronto, or in Victoria, we are doing a happy hour. The happy hour with the Ren group. So this is a live session. You come, we have drinks, we have meals, and it's at a local restaurant. And so it's very casual now. So this is the Women's Real Estate Network group. I'm one of the community leaders in it. And so that happy hour is happening this Wednesday, Toronto, Vancouver, and Vancouver Island. Okay, so if you are in those areas, I invite you to come out. If you want to connect, please reach out to me and I will get you an RVSP invite to the happy hour. Okay, so that is this one here. And then the other one, let's jump into this one here. The coaching session. This is for the breakthrough analysis paralysis. If you are stuck on your analysis, if you're watching my sessions and like, oh my God, I'm stuck, Hung. I still like, even after your, 15 minutes, I'm still stuck. Well, then this group coaching is a great way for you to break through that analysis paralysis that you have. Okay, so I will talk about some of the other sponsors later on. So let's jump right into the vacancy stuff. So like I mentioned, this vacancy stuff is super important because when you're looking at any opportunity, and it doesn't matter what asset class you're in, vacancy is an important number to understand. Now, keep in mind, it's only one number. So, of course, there's a gazillion other numbers that you need to look at. So, before you go and implement what I'm talking to you about here, please go and double check with another investor and make sure you understand how it affects you because it does affect your cash flow. It affects your evaluation on the building, and it can affect your financing, your funding for your opportunity. Okay, so this is a simple spreadsheet that I put together. Okay, so there's going to be two tabs that we're going to look at. The first one is just saying, hey, you know what? I've got an 8-unit building, and if it's vacant for 15 days out of the year, okay, what does that translate to in terms of vacancy? Okay, so the easy math on this is you just take your number of units times your the number of days. Okay, so we're going to go here. The number of days divided by your number of units, and then you multiply it by the 365, which is the number of days that you have in the year. So this is telling me that there's, very low vacancy here. Okay, like 0.5%. So this is super awesome. Okay, so right now I'm getting ready to build an 8-plex in Edmonton. And if I can achieve, a 15-day vacancy for the course of the year, that means I'm at 0.5% vacancy. This is fantastic. So the opposite number to this is the occupancy. And so if everything's rented out, you got happy tenants in there and there's no vacancy, well, then you're at 100% occupancy. Okay, so then it's just the opposite. So the occupancy rate is just 1 minus your vacancy. Okay, so now to make this a little bit easier, I'm going to change this total number of units to 1 so you can see this. So if you have 1 unit, so if you have a single family and it's vacant for 15 days, then your vacancy is around 4.1%. So when I run my analysis, we usually run it with 1 month of vacancy. Okay, and the reason for that is something that I learned from Don Campbell and the Real Estate Investment Network is that you want to run it with 8% because it's a single family. The more units you have, then that decreases the vacancy. Okay, so, and you want to run it with 30 days minimum because when a tenant moves out, you need to go do a little bit of renovations, you need to advertise, there's a potential vacancy of 30 days. So usually when I'm looking at single families or a duplex, I run it with my 30 days. Even if the current seller is telling me, no, Hung, you know what, we have no vacancy or the vacancy is really, really low, I still run it with 8%. Okay. Now, if your building is bigger, like I've got a 44 unit building, okay, well, look at this. The vacancy is 0.19%. That's with one unit sitting vacant for 30 days in the course of the year. So as you can see, the scalability of this, the more units you have, when somebody moves out, it's a non-event, right? Because the vacancy is so low because you have so many other units paying for the mortgage pay down and paying the rents to help you get the mortgage pay down. So on my current project that we're working on, it's a 40 unit building and we're running our pro forma with a 1% vacancy. And so the question that came back was, Hung, that 1% seems really low. Okay, so if one unit sat vacant for 30 days, so 1 month, that is 0.21% in vacancy. So now let's just say we go up to 90 days. Okay, so that means one unit is sitting vacant for 3 months, or 3 units is sitting vacant for 3 months. So as the total of all the vacancies is 90 days. Okay, so we're still at 0.62%. Okay, so that's still below the 1%. So now let's go up to 120 days. Okay, okay, this is where like a what if might be good. Okay, so here we've got 150 days, and that's where we just reached that 1%. Okay, so this complex would have to have 5 units sitting vacant for 1 month each, or a combination of total of 5 months in vacancy. Okay, so one unit potentially could sit vacant for 5 months, let's just say. Okay, so then that's where you would get your vacancy of 1 month. Now, how does this translate in terms of dollars? Okay, because that's also the other thing to think about. Okay, so when you are renting it out, and let's just say the units are going for 1,300. I'm just picking a random number here. So the rents per month for all the units, and I'm just assuming that all units are being rented out at 1,300, which isn't the best way to go about this calculation. So I'll show you on the second tab how the numbers would work out if you were to take into rents specifically per unit. Okay, but just at a very high level, this is what the numbers would look like. So the rents per month for all units, okay, is $52,000. And that's because there's 40 units. If you only had one unit, well, then your rents per unit would only be 13, okay? So that's why the strategy of buying multifamilies is there's such a strong case to buy multifamily just because of the scalability with the total rents that you would be able to get. Okay, this affects your NOI at the end of the day. Okay, so when you go for funding with the lender, they look at your total rent for the entire complex minus your vacancy. Okay, and so that affects your NOI and your funding big time. Okay, so now so I'm just going to go back to 40 here. So let's just say here now, so the rents per year is $626,000. Okay, like that's so cool. Okay, so your vacancy is 1%. So your total rents after vacancy is 617,000. Okay, so you have a rent loss here of 6,400. So as you can see, like, yes, if you have more units and if it's sitting vacant longer, you're going to have more of a rent loss. Okay, whereas if you only had one unit, okay, look, your rent loss is still the same. Okay, like that's a huge difference. So your total rents from 15,000, you've lost half of it because you only have one unit. Okay. But if you have 40 units and you have some vacancy, it's not as big of an issue, right? Your lost rent is still going to be the same, regardless if it's one unit or 40 units, because the number of days that your total rents are all completely the same. Okay. Totally mind-boggling. Like if you understand that, the scalability of this, if you buy more units, so much better, especially if it's all in the same complex. Okay. This doesn't work if you have, let's say 10 different 10 single families, and each one has 150 days in vacancy. Okay, it doesn't work. But if you've got 10 single families and then in total it's 150 days in total, okay, then that makes a difference. Okay, because if you see you got 10 units here, you're charging 1,300. Your rents at the end of it, even after with the vacancy, is still 150,000. Okay, and you're only out of pocket $6,400. Okay, so the number of days in total across your entire portfolio makes a huge difference. And so this is really important because when you are checking and doing your risk mitigation on your portfolio, you want to know what your total vacancy number is across the entire portfolio. Okay. So, like, say in my Toronto portfolio, pre-COVID, we had 0%. Like basically, the minute somebody moves out, within 3 hours, we have somebody moving in. Okay, so the vacancy was zero for a huge chunk of time. And then during COVID, we had 100% vacancy for like 2 months, right? Which was totally insane. Okay, so this is one easy way to master vacancies in minutes. Okay, so if you understand this, then you totally understand how to do the vacancy. Okay, so now I'm gonna take it one step up and say, okay, well, let's break it down by unit, by rent amount. Okay, because if your rents are different, like if your building size is different, like the unit composition is different, then that's going to affect how much rents you get in each one. So for example, like in my 8-plex build, we've got 4 units that are 3 bedrooms and then 2 units that are 2 bedrooms. And so those are going to be quite more money. So let's just say on the basement units, we're going to get 1,300. I think we should get a little bit more than that. And then on the upper units, let's say we get 1,800. Okay, so I'm just going to put that here. So as you can see, and then I'm just going to say the biggest unit has 15 days in total of vacancy. Everything else is rented out. Everybody's super happy. So as you can see, the vacancy, which is calculated as the number of days divided by 365. Okay, that's the same formula all the way down. So as you can see, for these units where there's no vacancy days, the vacancy is 0%. Okay, the lenders are never going to accept that. Your lenders are always going to take at least 1, 2, 3, 8%, depending on how big the building is. Okay, so let's just say on this last unit, we have 15 days of vacancy. Okay, how realistic is that? Depending on the location, right? Okay, so the calculation on this one is your 15 days divided by 365 days. Okay, so now if I go up to 30 days, which is more realistic, then you're at 8% here. Okay, now it's a building of 8 units. So it's not a vacancy of 8% for the whole building, right? Because you've got 7 that have no vacancy at all. Okay, so let's just say now my total rents per month for all the units is $12,000. Okay, that's pretty cool. So my rents for the year is $148,000. Now this is pre-expenses. So this is your gross income, your rental income. Okay, so 148,000. So now my total rentable days, okay, is I've got 8 units times 365 days. So that's how many rentable days I have. If so on my one building, I've got 44 units. Okay. Well, then I've got 16,000 rentable days. Okay. Which is huge. Or in my other project, which we have the 40 units, well, then we've got 14,000 rentable days. So it's just the number of units that you have times the total number of days of 365 in the year. Okay. So in this case, we're talking about my eightplex. We have 8 units times 365 days. So we have 2,920 rentable days in total. Okay. So what that means is now my vacancy is the number of days that it was vacant. So in this case, you just add up all the vacant days. So that's 30 days. And I'm going to divide it by my total number of rentable days. Okay. So that gives me a 1.03% vacancy rate. Okay. And so let's see. So I'm going to go back over here. I'm going to change this back to 8, and this is 30. Okay. And you'll see that this number, this vacancy number, is the same. Okay. So this is an easy way to calculate it. Just, if you're doing a pro forma and you're just trying to figure it out, hey, you know what, does a 1% vacancy make sense? If you have the breakdown in the rents and you want to be more detailed, I would only do this after the appraisal or after the inspection or after you've got your property under contract, because you don't want to spend too much time figuring out your vacancies until you know that the project's yours. Okay, so this one here is the vacancy number here. So let me just check to make sure that I've covered all of the points here. Yeah, so you know what? That really is it. Like, this vacancy number will affect your cash flow at the end of the day. And so you can see that big time over here. Like, you've got 8 units, 30 days vacant. Well, you've lost 1,200. Okay, in the whole scheme of things, that's not a big deal. But now when you have your rental income going down, okay, it's from 124,000 to 123,000. Okay, there's a loss there. Now, when you go and qualify for a mortgage or renewing, like, you're going to want to take that into account, because that's going to affect your lending. Okay, so this will affect your NOI, this will affect your cash flow, this will affect your property value at the end of the day. Okay, so I am going to end it there on this one. Now, oh, yeah, so you know what? It's important to understand that it does affect your Uncle Vic, okay? So now that's going to get a little bit sidetracked there. So what I want to do now is bring up this so that you guys can all see this. Okay, if you are in the Edmonton area, okay, this is something that you're going to want to check out, because, oh, it's not letting me share. Okay, here we go. Okay, if you are in the Edmonton area, this is a really good networking event to go to. Okay, it is happening this week. Okay, this Wednesday. Okay, if you're in Edmonton, go to the AREA monthly meeting. Okay, they meet once a month. It's in person, and you will meet a lot of other real estate investors and a lot of service providers. Like, this is one of the networking events that I would highly recommend. And if I was in Edmonton, I would attend this. Okay, so there's 24 people already signed up, so definitely go and check that out. Okay, the other thing that is coming up, not this week, but next week, is my mastermind. Okay, and we do this on the 3rd Friday of every month. And so you can get a ticket. It is complimentary, meaning that it is pay what you want, pay what you can, pay what you think it's worth. This month, we are going to be talking about the 100K strategy. If you have 100K, I can show you how to turn that into $1 million. Okay, no joke. Okay, so that is this episode coming up, this mastermind coming up this Thursday, sorry, the 3rd Friday of this month. Okay, so that is what I have for you, fabulous people. So thank you so very much for tuning in to another episode of Money Matters with your host, Hung Lu. Have a wonderful week, everybody. Thank you so much for watching. Okay, bye.